Imagine a company signs a multi-million-dollar contract. The ink dries, the wire transfer clears, and the cash is secured in the bank. Despite the signed paperwork and the immediate influx of cash, that company cannot report a single dollar of that money as revenue on its income statement yet. This highlights the core principle of modern revenue recognition. Revenue is not synonymous with cash flow. Revenue exists only when control of the promised goods or services transfers to the customer. To manage this, accountants rely on a strict 5-step standardized pipeline. By processing every transaction through these 5 distinct stages, the model ensures financial reporting reflects the actual delivery of goods and services rather than the timing of a payment schedule. Step 1 is identifying the contract. In financial reporting, a contract only exists if it meets a strict baseline of criteria, the most critical being the probability of collection. As the formal criteria show, a contract must be approved, have commercial substance, define the rights and payment terms, and present a high likelihood that the entity will collect the consideration it is entitled to. If those criteria are not met, for instance, if collectability cannot be reliably estimated, the cash received must be recognized as a liability. No revenue is recognized until the criteria are satisfied. Once a valid contract is established, we move to Step 2, identifying performance obligations. A single legal document often contains multiple independent economic promises. We must isolate each performance obligation as a distinct promise by passing 2 tests. First, it must be capable of being distinct, beneficial on its own. Second, it must be separately identifiable, not significantly modifying other goods in the contract. By the end of Step 2, the contract has been deconstructed into a list of independent economic promises. Step 3 determines the transaction price. This involves more than just reading the sticker price on the invoice. The total consideration requires 2 primary adjustments. Accountants must exclude amounts collected on behalf of third parties, like sales taxes, and adjust for variable consideration, such as coupons or credits. We can apply this to a specific case. This scenario involves a hotel contract to provide 10 rooms for 10 nights. The calculation is straightforward. 10 rooms at $200 for 10 nights equals a gross of $20,000. The hotel also collects a $7 occupancy tax per room. Because this is collected for the city, it is excluded from the transaction price. Finally, the contract includes a $3,000 credit for large purchases. This acts as variable consideration that reduces the expected entitlement. Deducting that $3,000 from the $20,000 gross leaves a transaction price of $17,000. After determining the total price, Step 4 requires us to allocate that $17,000 across the specific performance obligations identified in Step 2. This allocation is based on relative standalone sell-in prices. The best evidence for this is the observable price at which the entity would sell the good or service separately to a similar customer. When a contract contains multiple obligations, the transaction price is most likely allocated based on these directly observable prices. By the end of Step 4, we've accounted for third-party pass-throughs and variable credits to identify the specific economic value associated with each individual promise. Step 5 is the final trigger. Revenue is recognized only when or as the customer obtains control of the asset. Control is defined as having the ability to direct the use of the asset and obtain substantially all of its remaining benefits. This transfer occurs in one of 2 ways: over time or at a point in time. This basketball season ticket case study demonstrates over-time recognition. The team collects $3 million in advance for a season spanning November to April. By the December 31st fiscal year end, only a portion of the games have been played. Because the fans receive and consume the benefits as the games are played, control transfers gradually. The revenue is recognized sequentially as the team fulfills its performance obligation. We also recognize revenue over time if the entity creates a customized asset with no alternative use, such as a specialized satellite for an aerospace customer. If performance is not satisfied over time, it happens at a point in time. In this chemical delivery scenario, the payment terms are staggered across several months. The billing schedule does not dictate the revenue. Instead, revenue is accrued when physical possession and the risks of ownership transfer to the customer. Step 5 anchors revenue to the physical or service reality of the transaction. It ensures the income statement tracks the actual delivery of value, independent of when a bill is generated. The friction between cash flow and the 5-step model creates temporary imbalances. These are recorded as assets or liabilities on the balance sheet. Reporting standards require classifying these imbalances into specific categories. If a company receives cash before transferring goods, it records a contract liability, representing its obligation to perform. Conversely, transferring goods before payment creates a contract asset or a receivable. A receivable represents an unconditional right to payment, where only the passage of time is required. A contract asset means the right to payment is still conditional on fulfilling further obligations. Standards also prohibit netting contract assets and liabilities from different contracts against each other. They must be presented separately. The five-step model enforces a rigid, standardized translation of business activity. It ensures financial statements provide a verified depiction of economic obligations fulfilled.